technical strategist at MIG Bank. FX Street's probably kindly made brief introductions as to my background and potentially previous webinars that I've given. We have about 45 minutes to cover a very, very important and topical subject, euro-dollar, and the question which I posed today, a fall from grace, yes or no. And of course, this is down to the great fall that we've seen around 1,000 points below that all-important psychological level at 150. Of course, that happened a while ago. Now, before I actually go into the content of what I hope will be an exciting webinar on this topic, I just want a quick raise of hands. How many people here were actually attended previous webinars that I gave? So if you can just quickly put in your name or a yes or a no. Just want to get a quick survey. How many people attended previous webinars? There was one on gold and silver with the last one, basically looking as to how high gold and silver can go. Previous to that was on Black Swan shock event, covering oil and Japan, and of course the big market shocks that happened early this year. Okay, so a few people have said yes, and we have actually quite a few newcomers in today's session. So first of all, thank you for those who've attended before and continue to attend. This is kind of a good community that we're trying to build up here with MIG Bank in association with FX Street. But also a big thank you to newcomers that would have heard about this webinar, and I hope that you stay with us in the future. We'll be giving monthly webinars. Personally, I'll be committing to monthly webinars, and today we'll be looking at euro-dollar. So I'm going to get stuck right into it. Feel free to ask questions throughout. Let's get started. So just a quick disclaimer, all that I say is for educational purposes. It is important that for legal reasons I state that none of what I say is a recommendation to buy, sell, or hold any market or security. This is just pure observation. Of course, a lot of it is down to kind of hard work observations, but please just keep in mind that disclaimer. Okay, so just a little bit about my focus area. If you want a background on kind of biography background, that should be on the MIG Bank website or the FX Street website. Just look at the link now in the chat. But I want to focus more in terms of what tools, what types of analysis I use, just so you have an idea, a flavor of what I'll be covering throughout this webinar. Now, the three kind of areas I've crystallized are on the screen at the moment. First, market cycles and price geometry. These are very important areas to me. Market cycles mean price cycles, but then also economic cycles that I look at. It also allows an understanding relationships between different markets and how leadership can sometimes produce interesting trends. Second is more focusing on trade setups, and that's using Japanese candlestick trade setups. This is an area I've focused on for many, many years, and I'm more than happy to answer questions in future sessions on this. Incidentally, the next webinar in July 5th, which we'll give details on at the end of this, is going to be on trading Japanese candlestick trades during volatile markets. So just take note of that. The next session on July 5th will be on Japanese candlestick trade setups. And then lastly, some of you may or may not have heard of Tom Demark proprietary indicators, which I use quite largely, and this was a lot down to work that I did in association with Tom Demark in my previous role at Bloomberg LP in London. Okay, so let's start the question. I always begin all my webinars with a question to people in the chat. I want to make sure you guys are active and listening and thinking about the markets just as much as we are. And my question here is, from an economic or maybe technical perspective, which of these countries do you most favor? United States, Europe, or England? So from an economic or technical perspective, which of these three countries do you favor the most? Which ones do you think are most attractive? If you were at a beauty contest, which is what I've written here on the slide, which one would you choose? Which one do you find the most attractive? Okay, so a lot of people saying Europe and England, Europe. One person saying USA is bankrupt. Another person saying UK. Someone's laughing at the last comment, UK. So a lot of people are going for Europe and England, and this is interesting. I am going to be focusing on the technical side because, of course, that's my expertise. But it's very hard to discuss these really important markets without actually gauging the sentiment out there, which we all do on a regular basis because of the events that have taken place ever since the financial crisis of 2007 and the impact on each of these key countries. Now, of course, each of these key countries have important currency blocks associated to them. United States, of course, the US dollar, which is denominated across the board. Europe, of course, brings into question the euro and all the issues within the peripheral countries, the PIG countries, such as Spain, Ireland, Portugal, and Greece. And then England with various issues that country has and how that might impact the British sterling. So largely, the consensus opinion here is that a lot of you favor Europe and England most. I'll challenge that consensus in a bit as we move along. Now, I want you to keep in mind that the question I just asked is very hard for one reason. A poster that I've just pulled up on the screen, and this is a kind of scary picture of a forest fire. And here you have it's a National Geographic photo of one of the many forest fires that took place in 2008 and various other periods. And you can see that there's a lot of large-scale damage to the trees within the forest. And this is maybe how I like to kind of illustrate the problem at hand. If you think about this illustration, most of the trees are burnt. The key to a situation like this is to think in terms of relative. How do each of these currencies or countries, or of course the analogy trees, look compared to their counterparts? So if you think of it from a trading point of view, the issue is that there's a very low value, low quality environment out there. And there isn't much high reward opportunities to choose from. And so for that reason, we're looking for the tree, if you can just imagine what I'm about to say, we're looking for the tree which is least burnt. So each of these countries have problems. Most of you chose US as having the most problems, economically, maybe technically. And then some of you chose on a relative basis, Europe and England as having maybe a less problem versus the US. But overview, all of these countries have problems and challenges which they try and push through. But it is a relative game, and it is a low opportunity, low quality trading environment that we're in. And that's the key thing that I want to stress. Of course, the upside, the optimistic point of view is that a lot of the Asian currencies are now switching into very positive and optimistic cycles. And so they are now shifting into the kind of medium-term to long-term powerful trends. But just keep in mind when you're looking at the Western currency blocks, US dollar, Europe, and British sterling, these are currencies which are really having a tough situation. But a lot of the time now, it's choosing kind of between which of these trees are less burnt. Now, the way that, in my opinion, people have been choosing these currencies is not just on the back of economic comparison and not just on the back of technical performance, but also on the back of interest rate differentials. And so this is a key point. Of course, currencies are driven largely by interest rate differentials, and the reason why largely euro-dollar or the euro has been appreciating against most countries, most other currencies, is because their interest rate policy, central bank interest rate policy, has been quite aggressive compared to their counterparts. So keep in mind that that's what has kept the trend up for a while. Is that clear to everyone? I just want to make sure that that message is clear. So this is just a quick picture of a forest fire, just showing how this is a relative question. And relatively speaking, we are looking for currencies which are least affected by this forest fire on the back of the financial crisis and the economic woes that took place thereafter. Now, interest rate differentials is being the big decider here, and that is why largely we have seen the euro appreciate against each of its counterparts, because the ECB central bank has been quite aggressive on hiking interest rates, and so that has increased attraction to the euro versus its counterparts. So that has been the theme to date. My question to everyone here is, how long do you think that theme is going to last for? How long do you think the interest rate advantage, the euro, will last for? Now, this is a very cool screen that I've just taken from my Bloomberg charting platform, and it just shows you what people in the market, the financial institutions, banks, brokerages, firms out there, about 55 across the world, where they think euro-dollar will be over the next few quarters. So out of 55 financial institutions, banks, and brokerages, where do they think euro-dollar will be? And interestingly, you can see a big divergence. You can see just here that I've just shown you the difference of the most optimistic view in green and the most pessimistic view in red. You can see the most optimistic view is a move up to 151 at the end of 2011, quarter 4, and the most pessimistic view a move down to 120 at the same period. Everyone clear on that? So it's a big divergence of opinion amongst the biggest experts in the market around the world. And I look at this screen quite often just to see what the sentiment is like amongst the professionals out there in the market. Keep in mind 151 on the top side, 120 on the bottom side. Now, I want to show you what that looks like on a chart, because of course the chart is the most important thing, and that is what our profit and loss is associated with. And it's important that we look at these forecasts in the sense of how it looks on a chart. So this is a chart of euro-dollar daily chart going back to May 2010, and you can see the levels which I just cited. The move up to 150 or 151 is the most optimistic view that people in the market are looking for, and a move down to 120 is the most pessimistic that people are looking out for. Now, an interesting problem that I want to highlight here between these extreme views of people in the market. The move up, the most optimistic view, is just 3% from where we are now. It's a 3% reward from where we are now, or 592 pips. The move on the downside, the risk on the downside, is minus 16%, or in terms of those of you that like trading in terms of points, 2,408 points from where we are right now. And this is, for me, key, because a lot of us will look at these forecasts, but it's important to think in terms of risk and reward, maybe from a medium-term to long-term perspective, and just ask ourselves sometimes how far are we from these targets, be it a forecast based on economics or technical. So what I'm trying to say in a nutshell is that the risks are much larger to the downside, and the actual reward to stay in the trades that we're in at the moment, maybe over the next few weeks to months, is a lot less than it used to be. Now, what is pivotal from a technical perspective in my mind as to which way we go is this high that we had in April. I think it was April 11, April 12. It's the congestion area during the mid part of April, and that area is at 145.20. To me, this is very important. So for those of you who are trading the market or analyzing the markets, please write this level down. 145.20 on euro-dollar is pivotal to actually decide whether the bulls take us higher up to maybe the old highs near 150 psychological barrier, or a move below 145.20 may decide whether we continue in that larger correction, which was already down 1,000 points or so from the 150 area. That would then open up the risk, of course, for a breakdown of this massive uptrend that we've seen. Is everyone clear on that? So the forecast areas which I've just shown you shows a plus 3% bias or 592 pips up, or a risk of 16% down, which is 2,408 pips risk. And the key pivotal level for me, and maybe perhaps for you guys, is 145.20, which is the April high area. That should be a key decider as to what happens from here. Now, one of the things I want to keep in mind, some of you might remember this from a previous presentation I gave on gold and silver. This is kind of an educational slide which I designed with a friend of mine a while ago, just to explain something about risk-reward ratios. This is more for medium-term to long-term ideas, but just keep in mind that this diagram shows what happens during an overvalued market. So I'm showing this in association with what we've just seen here on euro-dollar, a trend which may be overvalued at these current levels. Now, what this chart shows is the blue line shows market price rising from kind of a base accumulation phase into a fast-moving momentum trend-driven stage into what we kind of see as more accelerated unsustainable, or maybe overvalued market stage. And that is usually the final stage of a market move. Now, during this entire time, we are making money or losing money, and that is what the red line is showing. The red line shows that you are making money steadily, and then suddenly you start to increase that profit accordingly as the market rises. And of course, during this time, the latter stage of this, you are making money in a very short space of time. But by doing that, you are also taking on a lot of risk. And so that is kind of what I'm trying to link here, the risk that you accumulate as you start to make more money. Now, this square area here, it just shows you the optimum area to be trading or investing in the market, and that is during this more conservative to more stronger performance in profit, but with a conservative risk premium priced in. Above this square area, you do need to start acting with tight stops. Market timing tends to be very important, and you should start be looking for potential exhaustion in this overvalued market. Now, is this clear to everyone, just from an educational perspective? Basically, what happens during an overvalued market in terms of risk and reward. So we might be making a lot of money at this point, but we are taking on a lot of risk. And that's basically what I'm trying to suggest for where we are at the moment. Now, moving on, I just want to just quickly highlight the analysis that we're going to go into now when I cover some of the technical analysis charts. And this is what's on the screen. For those of you who are interested in the way that I think on a day-to-day basis when I look at the markets, please feel free to note this down. This is what I call an analysis pyramid, and it basically depicts the most important areas at the top and then shows you how that drills down from stage 1 to 2 and then to 3. Stage 1 is always trends and maybe price cycles that is most important to me when I look at the market. Second stage is key levels. This can be Fibonacci levels or support or resistance levels and many other levels in the market. Keep in mind that there are long-term levels there are medium-term and short-term levels as well. And a confluence of each of these levels is what is most critical. And then finally, indicators. There are many indicators that I look at, but probably the most that I do is that I look at indicators which are not correlated with each other. And then I look at some of the proprietary indicators based on prior research. So this is what I'll be covering in some of the charts that you'll be seeing now. Trend and cycle analysis, key levels, indicators. Is that clear for everyone? Okay, moving on. I want to start with the euro-dollar hourly chart. I'm going to start from hourly, intraday, up to daily, and then weekly, monthly. But I wanted to start with a daily, an intraday chart because I'm sure this is what all of you are looking at as you try and work out which levels to enter or exit your trades. Now, this is showing you an hourly chart on euro-dollar going back, from today. I copied this just literally about an hour ago. And most importantly, it shows you that the trend has been quite positive, this rally within a longer-term correction. This rally has been quite positive, but one of the indicators that I look at that highlights trend exhaustion, Demark indicators, has signaled a potential trend exhaustion right at where we are now. So the kind of very exclusive point and signal that I want to highlight is that we are at the moment developing a Demark trend exhaustion sell signal at these current levels. Now, of course, this is just developing. It's not a confirmed signal, but just keep in mind it's an exhaustion signal, and the risk level, i.e. the level at which this signal may be negated, is at the level 144.66. So if we get a sustained push above 144.66, which is not far from where we are now, on an intraday basis, this signal might be weakened. But as it is so far, this is a mounting exhaustion signal based upon Tom Demark's sequential and sometimes combo signals. Okay, so for those of you who look at Demark indicators, you'll understand this. For those of you who don't, I'm happy to answer questions in future sessions on Demark indicators. Now, the reason why this signal is very important is because I overlay it as well with a few other types of technical observations. And here you can see an Elliott wave structure basically another way of looking at patterns in the market through fractal analysis. And here you can see that there is an impulsive 5-wave Elliott wave pattern on an intraday basis. You can see here wave 1, 2, 3, 4, and potentially 5, right where we had the Demark indicator signal. This also hits the top end of this trend channel ceiling, and I tend to draw a lot of trend channels on my charts. Looking at just a basic momentum indicator, the RSI indicator, we also see a lot of divergence on this RSI indicator. So there's a lot of kind of built up confluence information analysis suggesting that there might be an exhaustion trigger right where we are at the moment on an intraday basis. Now, if we were to get a move above 144.66, which of course is that potential weakening level, keep in mind that there's another channel that opens up a move up to 145, and remember that April congestion area at 145.20, which is still possible in the market, but I'm still kind of going for the more highly probable downside exhaustion downside move over the next few sessions. And most importantly, I'm obviously showing this to you ahead of the important U.S. Unemployment figures coming out this Friday. So this is why I'm kind of highlighting this short-term intraday trade setup observation. Now, on a daily basis, first of all, are there any questions on the intraday charts that I just showed? Any questions? I want to make sure that questions are answered. Any questions on the intraday stuff I showed? So I just started off with the intraday chart just showing you the Tom Demark trend exhaustion sell signal with a red 13 appearing at current levels and the risk level at 144.66. But then I overlaid that with other analysis showing you Elliott wave pattern structure, showing that this might be a 5-way impulsive move, which is potentially completing at the moment. And finally, a move above 144.66 congestion area. So if I just remind you that April area is here, 145.20. Okay? Now that's just for some of you intraday market observers. Now on the daily basis, it's kind of more of what I was talking about before, but just want to highlight this area here. I'm still looking at this as a short-term rally within a larger correction. So my view at the moment is, on a short-term basis, of course, I'm positive given the strong recovery that we've seen, but that is still against the backdrop of a very large correction that we have seen below that psychological barrier at 150. And so that's why I actually called this webinar or the question a fall from grace because of this 1,000 point fall here. Now at the moment I think that this short-term rally will be limited, as I explained, either current levels based on the intraday signals I showed you, or 145.20, or some of these other Fibonacci levels, 155.99, and maximum 147.29 as potential areas to sell any extension in this rally. But for the moment, the highest probability view that I have is 145.20 being a potential level to cap the rally for a resumption lower. Now the resumption lower will take us into key levels here at 141.48, which is the 32.8% Fibonacci retracement of the entire move that Eurodollar has made from January to the peak in April, or 50% level at 139.03, which is of course near the 140 psychological level, and then finally the 61.8% Fibonacci retracement at 136.59. These are the three primary Fibonacci levels that I look at on a regular basis: 38.2, 50, and 61.8%. Bear in mind that from a medium-term to long-term perspective, if Eurodollar ever breaks below 136.59, that would signal a medium-term to long-term reversal in Eurodollar's trend, uptrend. Is that clear to everyone? So going forward, a move below 136.59 would signal to me a potential reversal of the medium-term to long-term trend. Okay, now that's basically this chart here. And I'm going to move on to a monthly chart, just to highlight what maybe some of you may not have seen before. We tend to focus on intraday and daily and weekly charts, but this is a chart here on a monthly basis, euro-dollar. And what I want to highlight here is that euro-dollar is currently exhibiting a bearish monthly pattern, candlestick pattern, what we call a Harami pattern. This actually was a engulfing pattern not so long ago, before we had the short-term recovery within this larger correction. But the point is this bearish monthly candlestick pattern is weighing down on 5 consecutive months of higher highs and higher lows. So this bull run of 5 consecutive months, not weeks, not days, not hours, months, is being threatened by the current retracements that we've seen, the larger correction that we've seen on a monthly basis. So I would encourage you to look at your monthly charts just to see how much impact is actually taking place on the market. Okay, so this is on a monthly basis, just highlighting the monthly bearish candlestick pattern that is now threatening a bull run that we've seen of 5 consecutive months with high reaction highs and lows. Keep that in mind, and please continue to look at these medium-term to longer-term charts just to see what the larger trend or the larger cycle may be producing or weighing down on the market. Now, of course, the other side of the equation is the dollar index. So I've just been looking at euro-dollar, which is the psychological market that we look at and maybe trade on a daily basis. But what is critical is that we look at currency indices. And I look at a whole basket of currency indices, not just the US dollar index, but also the euro, the Japanese yen, and various other G7 currencies where you can get currency indices for. Now, on the US dollar index, this is a daily chart going back to January. You can see obviously the downtrend which everyone has been talking about. Technically, the US dollar has been down for about 40% for the last 2 years or so, and maybe 10% year to date. So everyone is aware of the fact that US dollar is devaluing, and that there are various economic reasons as well as technical reasons as to why this is happening. Now, the question that we must always ask ourselves as market observers is, when will things change? And what levels will change the current dynamic? Because of course that the market is dynamic and it changes on a day-by-day basis. So the previous theme is US dollar depreciating, but when will that change? Now, of course, that changed around the late April lows. On a technical basis, the market became very oversold. So although from economic perspective, US dollar problems were still there and still very big and obvious, on a technical basis, the US dollar index was actually at extreme levels and very oversold levels, very undervalued levels. Also, it broke below this falling wedge pattern, this kind of failed breakout, which then kind of pushed back higher. But in during that period, it also triggered another Demark exhaustion, trend exhaustion buy signal. So this red 13 on the lower side is showing you what triggered as a buy signal for the US dollar. Now that has since corrected higher or pushed higher into the 38.2% Fibonacci retracement level of this entire move, and we've basically been range bound ever since, currently around 74.53. Now, in my opinion, it looks like we kind of hold around these areas. The biggest risk to this current fall is to 74.11. I believe that this short-term reaction is limited to 74.11 before a highly probable resumption higher, back above the highs, above 76, into these other key levels, 77 and then 78. So basically, I'm looking for this minor correction to be limited into 74.11 for a resumption higher, back above these highs into 76, 77, and 78.03. That, of course, offers a lot of importance to all the major dollar currency rates that we look at. So although I'm only looking at euro dollar, keep in mind all the other currencies connected with the dollar that we look at. Now, what will assist this recovery in the US dollar is actually a lot of liquidity which is being reversed in the market. So a lot of what I look at is liquidity readings, and this is liquidity readings supplied by the CFTC exchange in the United States, where they basically measure the number of professionals in the market who are long, and the number of professionals in the market who are short. So how many people are buying, how many people are selling. And the net difference between that is what you're seeing here, this red histogram. Here you can see net long positions in the market peaking, and here you can see net short positions in the market bottoming. So kind of extreme net short positions in the market. Now this is a very important chart because what it shows here is that the extreme net short positions in the US dollar, so the number of net sellers in the market on US dollar, reaching a historic extreme in March of this year. Now, usually the way I look at this indicator is whenever we reach extremes, I usually expect some kind of unwinding or mean reversion back to more normal levels. And I sometimes look for divergences on this liquidity indicator for potential moves in the market. And we can see here that whenever this liquidity indicator reached extremes, there were massive counter moves on the US dollar. So an extreme move here, we had a massive move up. Extreme move here, we had a massive move up. An extreme move here, we have a potential massive move up to the upside due. Each of these moves is over 10% gains in the US dollar index value. So just keep that in mind. Some people in the chat just saying, one person saying, if Germany leaves Eurozone, then yes, we will buy the Deutschmark. Humorous note that I will keep in mind. But yeah, of course, it's not Germany that everyone's worried about. It's Greece and various other peripheral countries which are being rumored to have much stronger challenges and potential defaulting issues as we speak. Anyway, going back to the technical chart, this is the US dollar index, just basically showing how liquidity readings have reached extreme net short positioning and have since been unwinding. Once you see these net short positions move above the zero line, then you'll see a lot of renewed long positions, buyers in the market in US dollar, and that will produce a lot of further upside in US dollar, which of course will produce a potential further downside move in euro dollar. Okay. Now, on a long-term basis, keep in mind this chart. This is the US dollar monthly chart going back to 1980. Now, maybe not a lot of people go back this far in time, but to do a lot of the analysis, which I love to do, and that is cycle analysis, both technical and economic, I look at as much historical data as possible. History offers you a lot of insight as to what might happen in the future. Maybe not exactly the same as the past, but it at least highlights patterns that may repeat. Now, here, what we have is this very strong downtrend in the dollar, and of course you can see that the US dollar index has dropped from around the 160 mark to around 74, and this has been the massive depreciation in the US dollar, which we all know. And a lot of that is down to the 800 billion gorilla debt, 800 billion US dollars that the US dollar is now in debt, and of course the problems that will create and continues to weigh for the US and how that impacts the US dollar. Having said all of that, if you look at the price structure since 2000 to date, it does fit within a pattern structure, Elliott wave structure, a 5-wave structure, 1, 2, 3, 4, 5, which actually bottomed in 2009. And since then, we've had this kind of range-bound period, which a lot of are you familiar with. Now, my observation is that we are actually bottoming on the US dollar on a short to medium term basis. So we are creating a low in the US dollar on a short to medium term basis, which will has the probability to produce a big recovery up here, this green arrow, into the 89.72 area or the 90 psychological area, and then much higher into this trendline area. So that is basically my view over the next weeks and months. Now, once that potential move takes place, we then are more than likely to resume this massive downtrend back lower beneath these lows, and then continue with the problems that the US has. Keep in mind that all of you that actually chose Europe and England as the better countries or the better currencies over the US, this is a relative gain. And so the reasons why you are positive on Europe and England now might be the reasons why you switch over to US dollar on a relative basis. And these themes change on a day-by-day basis. So if you're very bearish on the US dollar, ask yourself what will allow you to become bullish on the US dollar over the next few weeks or over the next few months. Now, obviously, the easiest way to become bullish or bearish is to look at your chart and choose, look at the trends, look at the key levels, and look at your indicators and work out, what areas would change your mind. From an economic perspective, what I do want to highlight is this chart here, just very quickly, on the Bloomberg terminal. Basically, it was a chart of U.S. interest rates, or the Fed fund interest rate, and it just shows, for those of you that maybe see it, it shows what people are forecasting for government rates, and it shows here that I'll read it off the screen. One second. Basically, by the end of this year, people are looking for an increase to 1% on Fed fund rates from the U.S. side, and then potentially 2% into early 2012. So basically, a lot of people are forecasting, based off the 50 or so financial institutions out there around the world, the professionals in the market are starting to forecast a hike in Fed interest rates at the end of this year and early next year. So 1% or 2%, and that is, of course, from close to zero interest rate policy. Now, of course, that will change the status quo that we have seen on the currency markets, because interest rates on Europe will start to maybe be higher than Europe and maybe England. That is a potential scenario that I want to maybe encourage everyone here to maybe price in. Interest rates in America may start to increase by the end of this year and certainly into early next year. Now, the main reason for this, or the main driver behind this, is of course on the back of the exit strategy, which the Federal Reserve has been talking about quite regularly recently. So this whole exit strategy, this whole idea that the Federal Reserve in the U.S. starts to reduce the liquidity that it has been pumping into the economy as it starts to deal with other problems like inflation, mainly commodity inflation, and a devaluing currency, and maybe other problems that it wishes to address. But just keep in mind that over the medium term, so by the end of this year and early next year, a lot of people in the market are pricing in higher interest rates, short-term interest rates in the U.S. And that may actually steal the story away, the positive story away from Europe and away from England. Keep in mind that during that time, Europe may actually start to take on more event risk with some of the PIG countries, the peripheral countries like Greece, Ireland, Spain, and Portugal. Maybe more issues developing there. I tend to look at the CDS, the credit market, and various other kind of risk measures in those countries, just to see from a technical perspective how risk is increasing or decreasing in those markets. So I would encourage you to look at risk proxies for each of the European countries. Now, someone's just saying here, remember, Greece and Portugal is less than 5% of Europe's GDP. I'm not an economist, and of course my expertise is more in technical analysis. One thing I would say to that is that is true, but the psychological contagion of any one of the countries in Europe defaulting or having issues is actually what people are going to trade. And this is what is so important about technical analysis and the markets generally. It's not so much about how the economic numbers stack up. It is the perception of the market and how people decide to invest or trade based on their perception. And so I would really say that in terms of event risk, the contagion, the psychological contagion, is actually what is most risky in the market at this time. Now, a few questions I want to address here. Ron, don't you think that USA is devaluating the US dollar on purpose so they can activate their factories, encourage exports, get more jobs? In other words, activate their economy, and that's why they are not thinking about raising the rates anytime soon. That is true, but it's a dynamic game, and interest rate policies will change over time. They've kept rates at close to zero for some time now, and that may need to change because the other side to what you are describing here, the devil's advocate, the big problem which the US is facing is potential inflation. That is one of the arguments out there. Is California not considerably worse and more relevant than the US context? I agree. There was an article in the Wall Street Journal not so long ago highlighting the top 4 countries that are likely to default over the next year or 2 or 3. And the top 4 countries and states were, if I remember, Portugal, Ireland, Greece, Portugal, Ireland, Spain, and the 4th state there was Illinois, and the 5th one was California. So it's not just about Europe, it is about the United States within America, which are undergoing a lot of issues. But again, go back to that analogy that I highlighted with the burning forest. Keep in mind that it's a relative game. We are looking at if you think of this analogy, trees which have a downturn of the financial crisis or investing environment. So we're choosing between the lesser of 2 evils from a macroeconomic and in some cases technical perspective. So just keep that in mind. A burning forest, we're looking for ever since the economic downturn of the 2007 financial crisis. Each of these trees illustrates any of the markets or currencies that you may be looking at, and in this kind of low quality trading and investing environment, we are choosing the best relative reward out there. But it is a relative game that we are playing. Okay, so I just want to make that point very clear, because the arguments that we're discussing now are very important, but we need to keep in mind that it is a relative game, and that game will change between US, Europe, and England day by day, week by week, and month by month. And in the case of the US, what is changing the most is this rhetoric of exit strategy, where they start to lighten up the liquidity that they are pumping in the economy, and how that might affect their interest rate policy. Remember, I showed you the screen just a while ago. Hopefully you can see it now on the Bloomberg platform, just showing you what all the professional institutions, the banks and institutions, the professionals in the market, what they are forecasting for U.S. federal rates. And what they are forecasting is from this close to zero interest rate policy that they've held for some time to try and stimulate the economy. A lot of people, a lot of professionals in the market are starting to raise their expectations for an increase of interest rates up to 1% and 2% by the end of this year and early next year. This should really encourage us to think how that affects all the traditional themes that we've been following and trading, especially within the currency world where interest rate differentials are critical. Keep in mind that one of the key reasons that Eurodollar has been trading where it is because of the higher interest rate differential that Europe has held during this time because of the ECB interest rate policy. Okay, is that clear to everyone? So I'm just trying to kind of throw a mixture of ideas here, ideas that I look at every day, but also hopefully ideas that might be useful to you. Okay, now remember this chart is just showing you the US dollar on a long-term basis and how this long-term downtrend line may actually produce a potential upside recovery target into the 90 or 93 area on the US dollar index. So I encourage you to look at the US dollar index on a long-term basis to look at these medium-term targets. Keep in mind that this would also be within this trend structure, this Elliott wave structure, 1 to 5, where it shows that the US dollar may be bottomed in 2009 and maybe going up into upside mode into this trend line. Long-term basis, keep in mind that I am bearish on the US dollar, especially once we break below these reaction lows and this major low. But for now, short-term to medium-term, I am turning bullish. I just want to answer some of your questions. Do you use any moving averages on your charts? Yes, I do. But I tend to look at moving averages in terms of cycles. So I'll look at cyclically related moving averages. Fibonacci I look at a lot because that ties in with a lot of my fractal analysis and geometry analysis. What other indicators do you use when you send reports from MIG Bank? Keep in mind that I'm more than happy to send you our research reports, which we write on a daily basis here in the team at MIG Bank, which is largely on FX, but also commodity and soon equity markets. I will look at many indicators, but I tend to look at indicators which are non-correlated, so indicators which look at momentum, volatility, and liquidity measures. Momentum, volatility, and liquidity measures. And out of the momentum indicators, I really look at the market indicators in a very strong way. Yes, I do look at harmonics for that question there. That's a very important topic for me, which I might cover in future seminars. Someone just said gold is better. I will talk about gold in the remaining minutes left. We have about 15 minutes left in this webinar, and I just want to cover the very last minute. We have less time, actually, I've just been told. Okay, so what I do want to talk about is this whole theme of risk. Now, one of the key ways we are going to know that maybe euro-dollar is reversing lower on a sustained basis, and US dollar may actually be pushing higher, is this whole idea of risk appetite. Now, part of the reason why euro-dollar is at these high levels, not just down to the fact that Europe has the higher interest rate differential over US and over England, but it's also because of risk appetite. Euro-dollar tends to be higher, tends to be bought during a high risk appetite environment. Now, I tend to kind of talk about risk appetite as a game of two halves. So for those of you football fans who've been watching Barcelona versus Manchester United very recently, sorry for Manchester United fans, good match, Barcelona. But going back to the point, it is a game of two halves. First half of this year has been a high risk appetite environment. I believe that the second half of this year may start to transition to a lower risk appetite environment, and that will affect a lot of the traditional correlations and markets that we've been following. Now, one thing I want to highlight is that one way to measure risk, one very good way, is to look at the VIX index. The VIX index basically is a measure of risk volatility, and here, this is a recent chart just showing you that VIX volatility, which highlights risk, is at a 4-year low. So volatility is at a 4-year low. It's actually the lowest it's been before the 2007 financial crisis. So in plain English, we are more comfortable now than we have been since the financial crisis. Now, I find that statement quite hard to believe. Please, if each of you can think about that, that we are all more comfortable now than we've ever been before the financial crisis. So that is quite strange. And the way that I like to explain that irony, that very strange point, is through this diagram here, which some of you may remember from a previous presentation. This diagram here is a famous picture from the 1920s when there was a great boom in New York Wall Street for, within the economy, and building skyscrapers was an example of that. You can see here, each of these people are basically part of the builders and the constructors on building the skyscrapers, and at the moment they are taking a lunch break, even though they're very high up on the skyscraper. So can everyone just think about this for a moment? Imagine that you were sitting here having a lunch break this high up in the sky. Now, one of the key things that you will notice is a lot of them are very comfortable, and it's that comfort zone which is the problem. And someone's just said here, we have to get used to how we are getting used to all the risks and the market shocks out there. Keep in mind that this year we started off with a revolution in the Middle East, a tragic earthquake in Japan, and continuing sovereign default challenges, and yet the market is at extreme highs on the equity market. The volatility VIX index is at 4-year lows last seen before the financial crisis, and this picture basically shows why that might be the case. And yes, you are right, there is a whiskey flask on the right. They were very strong-hearted builders back then, and that might actually help with taking on the pain or the market shocks at this moment in time and back then in the 1920s. Now that's the picture. That's basically what I'm saying at the moment. I'm saying also that risk may have peaked but at the end of April, early May, when silver crashed. So for me, the biggest elephant in the risk game for the first half of this year has been silver. And those of you who attended my last presentation on gold and silver would remember that the question I asked is, how much is silver appreciated year to date? If we look at the extreme low and extreme high, and of course the answer to that is almost 90% year to date. If you look at the major high in silver, silver has gained. But in the space of 5 days, I'll repeat it, in the space of 5 days, gold crashed 30%. And it wasn't just, a big psychological move for people who are trading silver, but that was, in my opinion, from a market sentiment perspective, psychological contagion that spilled over across other commodities. We saw oil fall more than 10% in 1 day. We saw copper and many of the gold and many of the commodity markets capitulate during that week. And a lot of the commodity markets were actually part of a high risk appetite trade theme. And I believe that silver's crash 30% in 5 days may have signaled a peak in risk. So just keep in mind silver as maybe producing a leading indicator to risk peaking out in the market end of April, early May, and that may start to show through, translate into the markets that we trade on a day-to-day basis. One of the very important indicators of risk to look at is the gold-silver ratio, and I can explain that in future seminars. But just keep in mind that ratio has now unwound over 34%, and that is showing you that maybe risk is continuing to unwind in the market. If you overlay this chart to the U.S. equity market, or most equity markets, if you turn it upside down and overlay it on the equity market, this is actually a good leading indicator to potential downside risk in the Western equity market. So if you turn this chart upside down, silver-gold ratio, turn it upside down and overlay it on the Western equity market, this provides a good leading indicator to potential downside risk on the Western equity market. So the fact that silver has moved up 34% from this dramatic fall, the fact that it's come up 34% is a potential leading indication as to what may happen over the next few weeks and months during the summer low volume period. Now key to this is going to be I've got US GDP figures here. I don't have time to go over here, but just keep in mind that I do look at economic figures. I'm going to end this webinar on economic figures in the US, of course, because of the US employment non-farm payroll figures which are coming out on Friday. Keep in mind that it is important to take this event risk in mind when you're thinking of analysis or trade setups into the end of this week. And this is just showing you here how US GDP tends to be cyclical, and anytime US GDP is below the zero line for 2 consecutive periods, that produces a textbook recessionary low in the US economy. This is just showing you how US GDP growth has actually unwound ever since it hit the 5% area from this big rebound from a very low base, and is now starting to move down. So people are worried about slower economic growth in the US. This is what it looks like on the chart. We're now at 1.8% US GDP on a quarterly basis, and from a chart perspective, we are pushing down within this corrective stage. Now, that economic potential slowdown or downturn will be magnified by unemployment. The more people are unemployed in any country, but especially in the US where unemployment is close to 10% and higher, the more challenges for economic growth. You need people to be employed for the economy to grow. You need people to be employed for people to spend money and allow production and spending to take place. So the big number that we'll be looking at on Friday is U.S. employment non-farm payrolls. And so this is the long-term chart. U.S. non-farm payrolls going back to 1970, and you can see here the big fall in non-farm payrolls ever since the 2007 financial crisis debacle, which went below the 1974 oil crisis lows. So unemployment levels had moved much lower than the 1970 oil crisis lows. But then since then, we've had a massive positive recovery in employment levels. Right now, we're within a range, and the level at the moment is 244,000 employed within the U.S. based on non-farm payrolls. Keep that in mind when the figures come out on Friday. So if we get above 244 or we get below 244. The key level for me is when we break these lows here. I haven't put the levels on the chart, but if you just look at U.S. non-farm payroll on a historical basis, it is good to see chart points on this economic chart. The last chart, which I'm going to end on, is an intraday chart of euro-dollar showing you what happened last time U.S. employment non-farm payrolls came out. And this is just basically showing you an intraday 60-minute chart on euro-dollar when it basically hit that, was close to that 150 psychological level. So you can see here euro-dollar was holding with that range. U.S. non-farm payrolls came out last month, better than expected, but we broke out this range just before the figure came out. So we broke out of this price range just before this economic figure came out, which was quite positive, above expectation. And we had a massive fall down. So the point behind here is it is important to look at the technical or the chart context when you're trying to price in these economic events and these event risks in the market. So look at the chart to see what key levels we are at, what key trends we are within when the economic figures come out. And just keep in mind the intraday chart, which I showed you originally, and I'll just quickly go back to that, which shows you this exhaustion signal. Just one second, which shows you this exhaustion signal on the chart. I'm just going to quickly bring it up. Just showing you this potential Demark trend exhaustion signal, which is within this trend Elliott wave pattern. So this is just showing you that we may be limited to moves. This rally may be limited to moves within the 145.20 area. Now I'm going to within the larger direction. I'm going to end on that and just end on the final slide, which is just a little bit about what we do at MIG Bank. If you have any questions, please feel free to email me on my corporate account r.william@migbank.com. I'm more than happy to share knowledge and get back to you. Also, I'm happy to send some of the charts that are within this PowerPoint presentation. And for any of you that would like to receive our research, there is an exclusive 1-month free trial opportunity. Just again, send me an email on r.william@migbank.com and you can receive our daily analysis. So that's it. Vicky from the FX Street team is saying that we only have 1 or 2 minutes. Please keep in mind what I've just said. We can send research to U.S. customers, so please feel free to send any emails. And keep in mind, the 5th of July is my next webinar. Please, if the FX Street team can kindly put the link into the chat, the web link for the next FX Street webinar from MIG Bank from myself, and that'll be on trading Japanese candlestick patterns in volatile markets. July 5th, trading Japanese candlestick patterns in volatile markets. I'll be keeping you guys up to date in my research. Thank you very much for enjoying my presentation, being present. It's been a pleasure and an honor, as always, speaking to you this evening from Switzerland. I'll be heading back home now just to kind of look back at my chart. Thank you very much. The link is there if you would like to sign up to trading Japanese candlestick patterns in volatile markets on the 5th of July. Thank you very much, FX Street, for inviting me on this wonderful forum. And thank you for all the people who have attended previous seminars and who continue to attend future seminars. Thank you very much. Enlightenment through realized knowledge. Have a great day. Happy Wednesday.